Hey, I'm Rob Tatro from robtatro.com. Today we're talking about market timing. So it's a question that often gets asked. Should I be timing the market? Should I be trying to buy on the lows and should I be trying to sell on the highs? Obviously there's no direct, clear, concise, cut answer, but an investment philosophy such as ours and such as most people says that you're likely better off to just be invested. So the big thing is this new money that you're coming up with? If you just got an inheritance, if you just sold a piece of property, if you just won the lottery, or if you just accumulated a significant amount of wealth for whatever reason in one chunk, you really should not be focusing on market timing, and you really should be looking at being defensive and protecting the capital and taking away as much market timing risk as possible. Now, how would you do that? One of the strategies that we've used with a ton of success is legging in. Legging in is buying over time. A pre-fixed period of time, and the larger the asset is, the larger the net worth is for you, and the larger piece that cash is in regards to your net worth, the longer you should be using to leg in. If you get a $10 billion inheritance, you probably want to take a lot of time to leg that in. But if you get, a few $100,000, you could probably take less time. Let's take a couple, that they get about a $2 million inheritance, and they've got maybe 300-400 grand in RRSPs. So this represents, a good 5 times more assets than they currently have. So we definitely want to protect the capital. We definitely want to reduce the market timing risk in that situation. So one of the strategies that we'll use legging in, we'll pick a longer time there, perhaps 6 months, perhaps a year, perhaps 2 years of legging in. So a leg in strategy is every time there's a correction inside a week or a drawdown. So let's say the market drops 5% or 10%, those would be legging in moments. So that market drops 5, we leg in a portion of the asset. Market drops 10, we leg in a further piece. And if you get a period like a crash or a bear market where the market pulls 20 or 25 or 30%, you are buying all the way down. So it's not necessarily market timing, it's more using a pre-proven formula to reduce market timing risk. And in that formula, you'll be buying all the way down, and at the end of it, you'll have a portfolio that's close to fully invested, right at or near the bottom of a 40% market correction or something like that. That's a strategy that I really like. I believe it makes a ton of sense for people that are coming into new money. If you're not coming into new money, if you're simply investing your annual RRSP proceeds or your tax-free savings account proceeds and you want to put that money to work, we would suggest not worrying about the market timing, because you do not know if the market's going to be up a year from today or tomorrow. There's a bunch of things you can do. You could look at some technical indicators. You could try to look at multiples to see whether or not stocks are trading at a historically higher price than they normally would be. You can take a look at market cycles. Now, that is not for the faint of heart, and it's not for everyone. You can talk to your portfolio manager about that, but generally the easiest thing for most people is to invest those small kind of annual proceeds. You try to do them over a month or 2 or 3, but an even better strategy for you is if you know you're going to be making 50 grand in annual contributions, annual savings, try to spread that out. I'm sure your mom or your parents probably told you to do this, but in case you don't know, it's easy to reduce market timing risk by buying once a month for 12 months. It's a fairly common concept that I feel like most people have heard of and know about, and yet we oftentimes don't see that happening. So that's an easy way to reduce market timing risk. If you get a large chunk of money, we suggest taking a look at legging in, and we also suggest taking a look at, if in the legging in portion there is no dramatic market correction, you will be fully invested at the end of that, and you'll have taken advantage of the fact that you will have at least bought on some dips. So it's a complicated question. Please leave your comments below. If you like what you saw today, subscribe to our video, subscribe to our YouTube channel. We'd love to hear from you, and thanks for watching.